Hey guys, it's Ryan, finding a path to financial freedom for the self-employed. So it's official. The stock market makes absolutely no sense. At first I thought it was just me. I'm pretty new around here and still just getting a grasp on things. But as soon as I think I've got a concept figured out, there's the market just wagging its finger at me. So, is the stock market about to bottom out? Truthfully, nobody knows. But the market is doing wild things that can't help but beg the question. In this video, we'll cover a handful of reasons that explain why stocks have been falling, but also explore some things that might actually signal recovery. Let's do it. What the hell is going on around here? Tesla exceeds expectations. Good news, right? Wrong, I guess. After exceeding expectations by more than 6%, stocks dove more than 5%, presumably because they didn't exceed expectations enough. They already beat all the estimates, but it's not enough for these people. US GDP also outpaced expectations by almost a full percentage point and a half, yet the entire market takes a dump shortly thereafter. Consumer activity and business spending this year helped us reach our strongest year since 1984, yet investors are screaming and heading for the exits. Precious metals, crypto, basically every asset class is on fire, but with the markets going totally insane and acting in wild, unpredictable ways, could that actually indicate we're somewhere near the bottom? Or with forthcoming announcements from the Fed regarding interest rates, could we dip even further? Conversely, could the market be just about ready to turn back positive? I don't have a crystal ball, and like you, I don't have any idea what the future looks like. But for the self-employed investor, I think it's always important to explore both sides of the story, and let's see if we can at least make some sense out of what's happening in the markets. First, and maybe the most obvious reason that we could see stock values continue to plummet is high inflation. We're still experiencing the supply chain bottlenecks that started last summer, and those bottlenecks are contributing to a widespread lack of inventory, which is in turn feeding higher prices. Additionally, record high wages and labor shortages have thrown fuel on the fire. And who's paying for all this? The consumers, of course. The price on everything from eggs to choppers is through the roof, and for people on the lower end of the earnings scale, they're feeling it just about everywhere they look. In response to record inflation, increased action by the Fed, matched with instability and fear, is almost certain to keep investors on pins and needles in the short term. Next, let's talk about slowing demand and growth. Over the last couple of years, tech stocks have been utterly explosive, and while people were locked indoors and working from home, there was more demand than ever for technology. Netflix and other streamers experienced record growth, Apple sold unprecedented amounts of hardware, and Zoom, among other platforms that provided business continuity by remote, saw profits soar. But is all this sustainable? All signs point to no. The same companies mentioned previously, who've been among the top performers the last couple of years, are now reporting significant declines. During the holidays, Apple indicated a softening in iPhone demand, citing inflation and new pandemic concerns for the decline. Netflix is also feeling the squeeze, reporting its slowest growth in years, adding only 50% of the subscribers in 2021 that they saw in 2020. The third reason we could continue to see declines in the stock market is the impending interest rate hike. To give you some perspective, the job of the Fed is to keep unemployment to a minimum and maintain a 2% standard inflation rate. However, with inflation at 7% or better at this point, it's time for Powell and company to snap into action, which may in turn negatively affect the stock market. But why? I've heard it explained like this. When interest rates are low and inflation is high, the only place that investors can get a significant return on their money is by putting it into real estate or stocks. But when interest rates rise and investors have other options, for example, the ability to earn 2% in a high-yield savings account, 3% in a treasury bill, or 5% in a low-risk bond, there's less incentive to invest in companies whose value is based on future growth potential. This typically results in a decline in the price of growth stocks across the board, which largely include tech companies like Meta, Texas Instruments, and the aforementioned Netflix, to name a few. Fourth and finally, we have to discuss record high consumer debt, record high housing prices, and a return to pre-pandemic savings rates. During the pandemic, savings rates hit historically high levels, due in part to the massive influx of money being blown into the economy, governmental assistance through unemployment programs, and stimulus money, paired with more time at home and less money being spent out. Because people had no connection to this free money, emotionally speaking anyway, consumers had more money in their pocket than they'd ever had, and simply put, it was burning a hole in it. The benefactors were many, but of course, we saw a massive influx in investing over the last couple years in nearly every asset class, including stocks and cryptos. Further, because people had money, in conjunction with inflation and supply chain problems, prices went higher across the board, ostensibly forcing people to spend more money. This contributed to more spending beyond our means as well. Mortgage debt hit new highs and was the largest growing consumer debt category, jumping up nearly 7% from the year before. Number two, and maybe the biggest category of concern, is the spike in credit card debt, which has also set new records. The third biggest group was auto loans, but this increase is largely seen as a reflection of the exorbitant costs of new cars and used cars, not as a response to an increase in units sold. Anyway, the moral of the story is this: expendable cash is down, debt is up, and this is all bad news for the stock market. Because people have suddenly been forced to sell out of the markets or have otherwise relatively little to no extra cash to put back in, the number of people investing is on the decline, and subsequently, so could be the market itself. All that negativity, or reality, whatever we want to call it, aside, perhaps the other side of the coin is that there are indicators that we may be at or near the bottom already, and maybe this baby's about to bounce. Let's talk about recovery, shall we? First, inflation may be showing signs of slowing. It's too soon to say if we've hit the peak, but I do think we can safely expect things will start to get better, and hopefully before too long. With the anticipated rate hikes coming in March and beyond, the Fed is already beginning to anticipate a slowing of inflation in the next year, forecasting a return to something like 2.3% in 2023 and back to 2.1% in 2024. This is great news because despite having currently the highest inflation we've seen in 40 years, at least the Fed believes that the actions they are taking will prevent sustained runaway inflation. Are there any guarantees? Of course not, especially when dealing with the Fed. But sustaining inflation at current levels would not only be devastating, but it's extremely unlikely. So Lord willing, they're right. Next, maybe a bump in rates isn't actually that bad a thing. It's true that higher interest rate values might suppress stock prices, especially in the growth stocks as mentioned previously. However, that may not be the case for the entire market. In fact, some parts of the market may actually thrive when rates go up. Historically, we've seen higher interest rates correlated with higher stock prices in the banking, energy, automotive, and transportation sectors. Studies also show that since 1994, the 12 months following the first rate hike have yielded an average increase of 7.3%. So the point is that while a rate hike will be suboptimal for some, others stand to benefit, and from an investor's point of view, it might help dissuade fears of total market collapse. Another indicator that markets may actually be at or near the bottom can be seen in the behavior of small cap stocks. If you need a refresher on the different cap sizes and what they mean, check out my Market Cap for Beginners video. I'll put a link in the comments below. Historically, small caps have been a harbinger for things to come later in the broader stock market. They tend to move ahead of the index, leading the way for larger companies who will come along later. In the last week or so, the Russell 2000, or the small market index that's made up of the smallest 2,000 stocks in the Russell 3000, has hit a sort of bottom and begun a return back to the average PE ratio seen before the crash. If this does in fact prove to be a sign of things to come, some suggest that we could see a similar bounce in larger indexes before long, signaling a kind of recovery. Finally, all the bad news in the markets may already be priced into the cost of doing business. There are no surprises here. Investors are aware of the news, they read the papers. Everyone knows and has probably accepted the fact that the Fed will be increasing rates at least 4 times throughout 2022 and 2023. They already have a sense that inflation is through the roof, and they're savvy enough to expect that as a result, consumer demand is likely to drop. This can be construed as a positive in that as low as prices have gone already, if these issues have already been priced in, there shouldn't be much more room to decline. Of course, like all the items in this list, there aren't any guarantees. However, the market is perpetually adjusting prices in response to environmental stimulus, to offset the news, both good and bad, so to think that what we're experiencing today might not have been on their radar is probably naive. All that said, we're not totally out of the woods, but I think we've painted a picture that at least indicates it's not the end of the world. And while some will lose a lot of money in this market, others stand to rake in serious amounts of coin. Not all that different from any other time in the market. In a video from a week or so ago, we talked about zooming out from the news of the day to hold a wider perspective of the market, and I think that advice, not that we give advice on this channel, is something to consider. For many self-employed, we may not know where our next check is coming from, or maybe we're in a state of panic knowing that tax time is just around the corner. Perhaps we're struggling with some of the very things beating down this market, like people and supply chain problems, or maybe we're just having trouble finding new work while markets are in a state of upheaval. For the self-employed investor, we can benefit from taking a longer view of our goals and recognize that this hiccup in the market is just that. If we focus our energy on consistently setting aside whatever we can set aside and investing where and when possible, we'll for sure see benefits in the long run and spare ourselves the aggravation that comes along with watching everything that happens in the short term. Thanks so much for watching. Smash that like button if you haven't already. Also, click to subscribe and hit the bell to be notified every time I drop a new show. If you find this content or anything on this channel valuable, share it and spread the good word. Get $10 in free Bitcoin when you buy or sell $100 or more in crypto at Coinbase using the link below, and join me here every Tuesday and Friday for more. We'll see you all next time.